I'm Mark Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. As regular listeners will know, the Voice of Insurance usually interviews people from the global wholesale, specialty insurance and reinsurance end of the market, insuring the type of risks that tend to have to cross borders to find the right type of coverage. Today's podcast is a slight departure from the norm, because I'm talking to someone who's working in the general insurance space in the UK. But they're doing so from a wholly original wholesale and tech-enabled angle that also incorporates one of the hot trends of the past few years, embedded insurance. Mark Christer is CEO of Wakam UK, a firm that uses the business-to-business to consumer and MGA models to go to market in niche lines of business where it can stay under the radar of the volume and scale players in the UK's hyper-competitive market. Wakam UK is the UK subsidiary of the rebranded French insurance group, which can boast an illustrious 200-year history as France's oldest private insurer, La Parisienne. Mark came into insurance because of his work in IT and has enormous experience in the UK market. He's the former managing director of personal lines for RSA in the UK, where he looked after the high-profile digital brand More Than. Given Mark's background, it's perhaps unsurprising that Wakam UK is aiming to bring technology, including AI, to speed up the insurance process and go live with new prospects within weeks rather than months. Wakam UK already had reasonable scale in its legacy form, but in its new tech-first guise, seems likely to achieve substantial growth. I think regular listeners will learn a lot from Mark and find a lot in common with him. In a world of hype, here is someone with all the experience and knowledge to make the promise become reality. His enthusiasm and positive energy is infectious, so I can highly recommend a listen. Enjoy the podcast. Mark, welcome to the Voice of Insurance.
Thank you for having me.
It's really, really nice to meet you. Well, we're here sitting in London, a busy serviced office space, buzzing in here. For anyone who's listening out there who doesn't know you, can you just briefly introduce yourself, run us through your career to date? Tell us that story that we all tell each other. How did we get into insurance?
Sure, of course I will. Well, like many of your guests, the answer is probably the same. I fell into it. I started off my career, my early career, actually in IT and project management, working for KPMG as a consultant. And I did many years there before joining RSA in the business and what's called digital nowadays. I think we call it that. And progressed my career there.
Was it RSA? Was it R or was it SA? As in, was it Royal or Sun Alliance?
No, I joined when it was RSA.
It already was RSA.
So I wasn't one of either county. I was a new boy in there. So yeah, I joined there and basically joined More Than when it was just started.
Oh, wow.
Running all the e-business, all the electronic trading, and then progressed to manage all of the call centers and all the operations, which was a really interesting job. And then set up More Than Business, selling commercial insurances direct before becoming the MD of More Than. So did that for a few years, then became the MD for personal lines for the UK under RSA. So I ran More Than, all our affinity, all our broker business, and did that for 5 years, working for Stephen Hester. That was a fascinating time. We launched new products and propositions, so telematics, launched the pet insurance that RSA became very good at, and then grew significantly a lot of our affinity business, so landing clients like Nationwide, John Lewis, Marks and Spencer. So really interesting time. But I came out of RSA over 10 years now ago, and then went out to the Far East and worked for private equity, setting up an MGA or a suite of MGAs out in like Australia and New Zealand.
What was that called?
It's called South British Capital, and it specialised in surety business.
That's good business, isn't it? If you can get hold of it.
Yeah. If you know what you're doing. It's also a good way to lose a lot of money if you don't know what you're doing. But that was a fascinating time. Really enjoyed it. And then came back to the UK in 23. And it's at that point I joined Wakam in October 23 to set up the UK business.
Well, tell us all about Wakam. Wakam UK, the part that you look after.
Yes.
Well, maybe the whole group as well, how it fits in.
Okay, so Wakam UK, we got our approval from the PRAFC in April 24. So we went live in August 24. So we've been trading as a full entity since that point. Now, Wakam UK's not a branch or a satellite office. It's a fully independent, regulated entity.
You've got a separate balance sheet.
A separate balance sheet, own board, own capital, the lot, okay? And it's part of the Wakam Group, which is based out of Paris. And in Paris, in France, you've got Wakam SA, which deals with the European business.
And the legacy, the real history, anybody who's been around long enough, it's La Parisienne, isn't it?
Correct, yes.
That's 200 years old?
It's very old, yeah. The oldest insurance company in France. So it was acquired by our owner-founder, who was a tech entrepreneur, and Wakam came out of that.
Now, a couple of years in, what sort of scale have you got up to for Wakam UK?
Well, Wakam UK just deals in B2B2C, right? We don't have call centers. We don't have websites for customers. We deal through third parties. That's how we manage the business. And we target insurance, tech, MGAs, etc. Okay. So Wakam is a group overall. It's about 850 million turnover. The UK's half of that. So effectively, when we set up the UK, it was a hell of an offer, but what I was able to do was to set up an insurance company, how you would set it up with the tech that's available nowadays. So I set up a greenfield insurance company in the UK, but I had the benefit of a 400 million leg up of business. So I didn't have to go out and find client one. I had that client already there.
So you had the mass.
And brought them across the branch.
So that was a branch office that was already doing 400
it's
million.
Already there and existing. So basically, Wakam UK is its own entity. We transferred the business over from the branch that we could see a way that would make money through the cycle. I didn't bring everything across. And then what we've got in the UK is a highly skilled team. So we've got about 35, 40 people in the UK. All of them have got decades of experience in the UK insurance market. And we've been able to onboard that business. Last year was our first full year of trading, so 2025. And we're in a really good place for moving forward.
And that business, was that all B2B2C business before? Or was that the previous strategy, or was that some of that legacy business that was just more standard business? Or
no, it's all B2B2C business. So what we're effectively trying to do is, our job is to offer good quality capacity to our partners and be there. We're using the skills and experience of our team to help them grow their business. That's what we're about.
And so that perception, if there's a broker out there listening, and I said, hey, what do you know about Wakam? What would you like them to say? If they really knew you, what would they say? And what would you want them to say? What's that perception you'd like to have of you out there?
I would be wanting them to say, this is a partner we can trust. We only engage in long-term relationships. We're not in for in and out. We back a partner, we back them fully, and we follow them through. And then in terms of, working with us, I would hope that they would say, or, our intent at least is we move with velocity, right? One of our things when I set this business up was, how can I design an entity that keeps pace inherent in everything it does as it grows? How do I get really good experienced people and use the tech to remove all the time-consuming, low-value-added tasks from them so they can be front of house and in the market? And then how do I empower them to make decisions? And that's what we've tried to build. And early feedback would say that we're on the right path. We do a net promoter score. I know many companies do net promoter score. We do it twice a year. And our existing partners come back and we got a net promoter of 60, which is very respectable. And the key things that we're saying is, yes, you absolutely do move velocity. One of the examples, we risked from first meeting to going live. We did it in 8 weeks. So that's a binder, live, product design, the lot, okay? Another example, we went live with a bank recently offering payment protection on a card. And we went live in 32 countries with that. And we did it in under 4 months, from the first meeting to live. That's velocity. It's not 8 months to get the binder. It's in and out.
How often is a broker sitting in there, or how often are you doing that direct?
We don't go direct at all.
So there's always a broker sitting there?
Always intermediate. So
someone's introducing you.
So exactly. So basically, we back people, NGAs, that are insurer techs that have got an offering that we believe will work through the cycle. So we target niche business. My definition of niche is they've got underwriting or pricing expertise or distribution or data assets that results in a lower than average loss ratio sustainably. That's niche for me.
Comparative advantage of some description.
Some description.
Yeah, so how we should think of you? Obviously, there's been this fantastic growth in hybrid carriers, we should call them, own balance sheet, but also support of a lot of reinsurance capital and other alternative capital. Should we think of you sort of in that breath? But of course, you're not quite the same because presumably you retain most of what you've got, or obviously you've got reinsurers like everybody.
Look, I think it's an obvious comparison. I understand why people would make that, but I would push back on it. We put our capital at risk. We aren't playing it for
You're retaining most of it.
20%. Yeah, we've got a majority say in that. We do use reinsurance, we do use quota share, but we're the majority. Our capital's at risk in these deals, right? And also, we have underwriters. We have also do all the risks, the compliance, and so on. So we are not a hands-off, we're a hands-on. It can be seen as intrusive, but because of the quality of the people and the quality of the insight, and because we're aligned on where we're trying to go, what our partners are saying to us is, then actually they just see it as helpful support and intervention. And actually, between us, we're co-creating things that make both companies go faster.
Are you comfortable being called an insurtech company? Obviously, you've got that fantastic 200-year legacy, which obviously is about as uninsurtech as you could be. But obviously, given the current ownership and that rebranding that you went through from La Parisienne, presumably, yes, the tech is part of what you're selling.
Yes, I mean, you can't have an interview nowadays without mentioning the AI word, can you? But honestly, in 24, we built the business on basically strong data assets, and AI, and we built AI into all of our processes because it's here to stay. It's going to evolve. It's evolving exceptionally quickly, and we want to leverage that. I'm actually quite lucky in a way because we are a new company and we haven't got legacy, and we can design from the ground up new, which is what we've done. I only see AI as an enabler to my business to help me solve problems quicker, to move faster, to solve our partners' issues, to give insight, and specifically in claims and areas like that where it can offer real value. If I was sitting in some of my older corporate jobs, I'd be looking at this going, oh my goodness, this is going to cause real ructions. It's got job losses written all over it. We've already seen in many parts of the country.
And also just upgrading your system so that you can actually implement it is, again, another real big headache, isn't it?
To be honest, it's less the systems, it's giving it much more access to the data. And then is your organization fleet and fast enough that underwriting, pricing, reserving are interacting in the day using it? Because AI goes left to right, it doesn't go up and down, okay? So many of our larger companies were going to find this quite hard to deal with, but there's significant opportunities if they can leverage it.
So of the benefits you've seen within the value chain, claims one big thing. Obviously, turning unstructured data into structured data seems to be the thing that everybody is very, very pleased with. But you're quite keen on already having those direct links anyway, that you've got the tech, i.e. you've got everything via an API already. So it's not like you're getting, like a standard open market underwriter with a typical broker submission with 3 spreadsheets, 15 different PDFs with inspection reports and schedules of values and all, if it was a property risk, for example, and the loss record with huge amounts of information. Presumably you don't really have to do that because you're already plugged in. That's already in the system.
Yeah.
And it's already in the kind of format you want it to be in.
There's special acceptances, there's other areas. And what AI, coming back to your question, there's 2 parts, right? On the claims part, absolutely. AI is a game changer.
Because it can read that initial report and it can elevate that straight up to you.
It can.
And say, this is a big, big one. We need to have a proper meeting about it.
And what we've tried to do is, rather than AI be something that you go to the IT department for, we've rolled it out in such a way that the team, the subject matter experts in the teams, are leveraging it. So, for instance, one of my team is my claims director. He's got over 40 years experience in UK claims. And he's written an AI routine himself. Well, he hasn't written. He's told it what he'd like it to do, and it's written itself. And it looks for 11 different types of leakage. And of course, the first couple of times I run it, it was giving lots of noise, lots of false positives, etc. And it's refined, and it's refined, and it's refined, right? So what that means is now every month, every single claim is looked at and analysed for leakage.
Using his brain.
Using his brain and his skills and his experience, right? So it's got all that insight and experience in that algorithm. Now, when I was more than in, our claims teams, I don't know, let's say we've got 500 people in the claims teams on the phone. We would probably have our best 30, and they would be listening to all the calls and sampling maybe 5 claims a month. of all those handlers to try and find the leakage. Well, you just don't need that now. So I'm able to, as a small entity, review every single claim every single month and spot the leakage or the fraud or other things. We have another report called Jumpers. So, any claims that, with his knowledge and insight, he thinks have got a potential to become a large claim, but get lost in the claims files or the processing. And
because, we've all seen them happen. They quietly compound, and suddenly the next time you look at it, it's about 50 times bigger than you thought it was going to be.
Thus, they're a jumper. So not something you wear, but they jump up in the air. So just practical examples of how it really could help in the claims process. But to your other point, AI loves unstructured data. It deals with it as much as structured data, okay? So it can read all of those subs reports, medical reports, whatever you need it to read, and pull back summaries to inform the person about what we do. What we have done, though, is drawn some strong red lines. AI doesn't make the decision in our company. It certainly serves up options and recommendations. Humans make the decision. And the second red line we've put in the company is it doesn't go across personal data, right? It's out of personal data. It doesn't touch employee or individual personal data.
Do you use it in the boardroom? I spoke to someone recently who said we've got an AI sort of non-exec director now.
Huh?
It tells me that what he's worried about, or it's worried about, or I don't know how we refer to AI.
We haven't yet. I like the idea.
The quarterly board meetings, like, yes, tell me what you're doing about this. I'm worried about cyber or whatever,
We do use it to record all our meetings and transcribe them and write up minutes and write up the actions. So that's really useful.
And when it's all there, of course, you could actually ask it to have a think about it. Have we missed something?
Yeah.
Or is there a pattern here?
Well, to be honest, I'm lucky. I've got a very strong board. It was one of the things that I spent a lot of time on when we were setting up the UK business. My board has got a lot of experience in it in financial services, which helps and guides me. I'm not sure they'd be pleased I'd replace them by AI, maybe next year.
So on the B2B2C, you don't do any open market business really at all, other than obviously when you have someone else to pick up the phone and there's a special acceptance, something that doesn't quite fit.
No, we basically back our NGs. Our NGs are the ones out there doing the trading and the underwriting. Now, we're involved in the underwriting. We set the frameworks for the underwriting. We agree price changes with them. But often we're able to add a lot of value into that just because of the experience of the team.
The typical nature would be, this is something where you're the 100% writer of this business. You're presiding 100% of the paper.
Although some of our MJs were co-insurers. So there's other insurers alongside. That might be their own insurance company, or it could be other names in the market.
But for some of the smaller ones or the sort of more niche ones, it sort of sounds like a thing you'd likely to write 100% yourself.
Yes.
Obviously, we're kind of London-centric podcast, so I apologise for that. But it's really great to have you on the show because you're giving us a much broader UK general insurance perspective, which is really interesting. And also what you're doing is really interesting. But sort of intersecting more with the world that I spend most of my time in, you had a syndicate venture at Lloyd's, but it was only a short-lived one. Tell us about it. What was the idea behind it? And, okay, obviously it didn't quite work out as planned, but what did you learn from that? And when would you rule out having another go?
So it was before my time. It was taken out. But the idea was it was a possible way for France to manage Brexit.
Right, okay.
But basically, once we got the Wakam UK approval, it really became very clear that we should be focusing our efforts on making the UK business successful and putting our capital into that. So it was a decision. We progressed and went, look, we need to focus. And it was just opening up too many avenues for management distraction. So let's land this. And so we took the decision to close it. So it was only open for about a year. So I think it might be one of the shortest lived ones.
Well, the thing is, of course, this is probably the biggest culture clash between technology and insurance. Tech is all about fail fast, try something, see if it works, and then move on and don't cry about it. But of course, insurance actually is one of the worst industries for that because, of course, you're not supposed to ever fail. That's partly in our DNA because, of course, no one wants their insurance company to fail or to fail fast, even worse. You want it to fail slowly at the very, very least, So it's not in the culture of insurance to fail ever because you're selling certainty and solidity in something that will never fail. And so you can't have a worse culture clash. But of course, we should get over that. In this world, we have to get over it, and particularly also what was that syndicate in a box type structure at Lloyd's was designed to actually fail fast.
Exactly. And look, I know we mentioned it earlier in the conversation, but it's why I fixate on velocity and speed, because that makes the consequences of wrong decisions smaller. because, if you can only go out there and do one IT change a year and you get your rates wrong, guess what? You're living with that for 12 months, every month knowing that you didn't get them quite right. If you can go out there and change it, 4 times a week, well, what are your consequences? Your consequences are a couple of days, right? So velocity and speed to market just allow you to work around these problems and then even make them up in other ways. If you have done something wrong or got something not right, it just reduces that overall burden. Culturally, it massively frees up the organizations as well. Imagine being an underwriter knowing that you can do 2 changes a year. If you get them wrong, well, you're not going to hit your year-end targets, you're not going to get your bonus and so on. What it drives is prudence and conservatism and people just load in stuff. And
I suppose it's a natural tendency to load the rate for all that uncertainty.
And looking after stuff. So if those consequences are basically taken away, then it frees people up to do the right thing and therefore work out, innovate and try and problem solve to get to that outcome you're looking for.
So you've constructed a feedback loop that's so much quicker that underwriter can see in real time what's going on, and they can quickly have a tweak and say, have you not noticed something's going on here? Or there's competition or there's something else happening.
And look, there's plenty of people out there doing it. I've always had so much admiration for Admiral through my time. I always used to, when I was up more than go, how are they doing this? How are they doing this? But actually, it wasn't any whiz-bang systems or anything like that. What it was some basic good MI, and they had really good lines between their pricing, their reserving, and their claims. They all knew what was going on, and they could spin that dial quickly and react.
It's got to be the key with that high volume stuff, particularly as we've seen, supposedly boring lines of business. They're never boring, are they? I mean, what happened with the pandemic, with motor, suddenly there was a loss ratio of almost nothing apart from a few rats chewing through cables and stuff. And no one's driving, cars rusting maybe. And suddenly there was that inflation. There was inflation in all the chip.
That's right. Everything's parts with Ukraine. And
and a bumper used to be a bit of metal made out of chrome, and it was a shiny thing. You could just bolt another one on. And now it's like 2,000 quid's worth of radar and God knows what else is in there. But the market can react to that kind of stuff really quickly, but also all trends in bodily injury or whatever. If whiplash was X and now it's X plus 20%, you need to feed it back incredibly quickly. Otherwise, you can be in deep trouble quite quickly as well.
And this is why I think this joined up approach across the business is so important. You're absolutely right. Seeing those trends, spotting those trends quickly, and then doing something about them is what's going to be key. And often functional structures find that quite hard to do because I'll have a view of what it means for me in claims. Pricing will have a view of what it means for them there. And actually, what you need is that cross-functional view if you're really going to move on it quickly.
Would it be right to describe you as an embedded insurance insurer? Because it's something that became a bit of a buzzword, particularly in the insurtech community. It's probably really got latched onto about 3 years ago.
Yeah.
And I think everyone's moved on to AI, enabled something and .ai in their names these days. And that's just the nature of tech that does seem to go in fashions. But one, is that a way of describing you that you'd be happy with?
Well, look, we do embedded insurance. We're set up for it. But we also focus very heavily on the MGA market. In fact, more of our business is in the MGA market rather than an embedded market.
And over time, do you think which one will grow faster? Will it be more MGA percentage? That'll be a higher percentage in the future?
Look, there's an awful lot of predictions out there saying that embedded insurance is going to be very, very, very big.
I'm always skeptical of that kind of thing because I remember having a discussion with someone on the podcast and there came a point in the conversation and said, well, in some places people trust their telecom company more than they trust their insurance company. So they'd rather buy insurance through the telecoms. And that was a moment where I have to be skeptical because if there's one company I trust even less than my general insurance company, it's my telephone company. I know that from bitter experience. So, it's maybe in different parts of the world. This is because this is a global company, maybe in parts of Asia or perhaps absolutely that the brand's actually stronger than your bank or your local insurance company.
Look, we're definitely seeing embedded gain traction. Lots of people now, when they buy the holiday, they click and just get the insurance for it at the same time. Yeah. Well, you get the rental car, you buy the insurance.
Yeah, but you see, that's the other thing, because it's one of the things I hate the most is rental car insurance. That deductible buyback, I strongly dislike it, and regulators should really take some shears to it. I really don't like it. So for me, I think if you could embed all the treating the customer incredibly fairly and whatever, the problem I always see with pure embedded is, of course, you're eliminating competition at that moment. If you were in your sort of airline, it says you want to do the travel insurance as well, along with your seat, and do you want the extra leg room and the baggage in the hold and all the other things, and do you want a meal and whatever. And if it said, oh, by the way, there's 3 different quotes for your travel insurance. Here's Allianz, here's AXA, and here's Wakam. And these are all different levels of cover. Bang, bang, bang. Which one do you want? There's no reason why the technology shouldn't allow that to be embedded.
There's none at all.
But at the moment, obviously, it's almost certain it will only be, do you want this yes or no binary? Do you want this insurance?
It tends to be. And probably mainly due to people's systems capabilities, because, not many of the people at the front end doing embedded insurance have a panel capability or what have you on the platforms. I mean, we're seeing where some of those capabilities are even in the insurance market. So, yeah, point's well made. I do think there is this sort of whole fairness thing. And, that's what consumer duty, fair value assessments are all meant to do. I think you tend to see them happen for much more transactional values. So, you're paying £1.20 for this add-on, or, that's where I think it works very well. And there's little friction and what have you. I think when you start to see the costs of the add-on, the insurance, whatever you want to say, become more substantial, then I think your point gets well made.
Actually, some embedded insurance is absolutely great. For example, in Spain, obviously with this terrible train crash recently, but one of the great things about Spain, they have an embedded state insurance scheme, which is written by the private market. But it's a great thing, but it's included in every train ticket. You get a small personal accident thrown in. Yeah, not very big limits, but it's a really great thing to have. Suddenly when you need it, and there's an interesting it's incredibly diversified. You get to write the whole of the Spanish railway network or the bus network of...
Well, there's a good example, right? Yeah. And look, the other one I use myself is if you're buying tickets to go and see a band or something like that. The cancellation cover, right? Because either something happens with our family, we're quite accident prone, or vice versa, it's the other end, because these tickets aren't cheap anymore. And, spending a couple of pounds to give you protection. I do it. It's my choice. I don't have to do it, but I do it and I take the value.
No, there's value in there. You can see the value in those, absolutely. What's your assessment? We've been talking about insurtech probably for 10 years now, which is interesting. What's your assessment of what's been achieved by this great movement? Or we haven't really just got started, haven't we, I would say? The amount of investment, of course, and the amount of talk has been substantial. I'm very grateful for it. I've spent a lot of time talking about it for 10 years.
Well, it felt very similar to 2000 and the dot-com bubble. Overhyped, too much money, big valuations going into things that people really didn't know what they were doing, certainly on the insurance side. And I think you've seen that burst. I think you've seen that contraction. I think what you've got now is a second wave coming through where you've got insurtechs that understand insurance, understand data, understand underwriting, have built platforms to check out for fraud. And so they are much more savvy to the market that they're trying to operate in rather than being, look at my beautiful web journeys or my beautiful designs. That's great. But is it translating into things that will move, a combined operating ratio? And they weren't. It was all about the propositions and the height and the front end. Yeah. So I think what you've got now is a more mature wave coming through. People have been burnt, people have lost money, and so they know the questions to ask now, they know where to back it, and I still think it will continue to develop, but I don't see it as a separate market anymore. I just see it as part of the market. It's sort of merged into mainstream, and mainstream sort of merged into it because of, the investments that have happened in that space and data and pricing, etc.
Yes, it's more of an ecosystem now. You don't just get two brainy kids who have got $50 million from somewhere anymore, who don't know anything about insurance. At least now you get the brainy kids and you might get the $50 million, but there will be people with grey hairs who've been running substantial underwriting businesses who are also part of that new venture, and they've got it really focused on what they're trying to achieve, and that this is something that is absolutely needed by the market.
The money's learned, okay? Yeah. The investment's learned. It was all chasing the bubble, but it's now learned if you want to get the returns, you need to have the underwriting and the pricing sitting within that as well.
The market itself, how's the UK market behaving? Obviously, my market, when you go look at the reinsurance market and the specialty end of the market, that excess and surplus end of the market is softening. Is it having any effect on the UK? UK market often tends to just behave on its own, in its own ecosystem. It's big enough to have its own market cycles that don't coincide with everybody else's. What's the state of the market at the moment?
Well, look, there's an awful lot of moving parts going on, isn't there? Rate has disappeared out. The market, we've seen that go quarter on quarter. I think even into commercial mid-market, I think it's seen some significant rate reductions over the last 16, 18 months. We've got consolidation going on, Aviva, Direct Line, GSE, sure. So you're seeing people using scale as a way to try and compete and leverage. And then at the same time, we've got a growth in the MGA market because people have recognised that getting into these niches where it's not economical for the scale players to play, therefore there's less competition, therefore, you can leverage your expertise is creating better returns. So I think you're seeing all of these things play out. I then also think you've just got societal changes going on. We're seeing changes. We'll fully see how this new Renters Act plays through on the property side.
Yeah.
You've got children staying at the parents' home for much longer than the parents ever envisaged, certainly from my perspective. You've got more ride sharing. You've got people actually getting back on the trains now. So there's a range of movements going on within consumer-driven changes as well that's all playing through. So in short, it's going to remain competitive. The UK market is so competitive.
You're happy that you've got plenty of opportunities for profitable growth. That's the main thing.
Yeah, look, this is one of the things that I think helps Wakam. We're not sticking rates into an open panel system and what have you, where everyone's just chasing to the bottom. It's all about your price, gets you your volume. We're choosing the niches. We're backing the MGAs that we think actually they're going off piste. They're finding ways to do it, finding niches to do it. They're finding distribution to do it. That isn't all about what's your price and huge price elasticity. So people move for not an awful lot. It's much more sustainable. And as we only do long term, then, we'll work with these people to improve that and grow their business. That's what it's about.
Do you think that this shift, that the MGAs are taking up a larger share of the market, and this has been something that's moved through different cycles as well, do you think this is something that's a permanent change now? Perhaps 30 years ago, we said, it's all a bit cyclical. When the market softens, obviously, carriers will lean on distribution a bit more, and therefore, if an MGA is coming to say they'll write X amount of extra income, the underwriters will say, well, okay, fair enough, we need that volume, so we'll back anything that will give us the volume. These days, it doesn't seem to be like that anymore. It seems that it is a permanent change. One, would you agree with that, or would you not?
Yeah, I would agree with her. I think it is a permanent change. And I think when the times are tough, then the tolerance within the big companies for making mistakes is low. Therefore, people get risk averse, they pull back. Well, that's exactly the time you need to find people who can navigate through that, who've got the agility, who the consequences of making a mistake because they move with space are limited and low. Therefore, they can rearrange. So actually, MGs, because of that capability, will survive even when the times are tough.
Right. And that's your pitch as well, isn't it? Because you'll be there with them because you back them and you're going to succeed together.
And I don't play in the other markets that compete with them, right?
Because you have worked at one of those very large insurance groups, and just sometimes you've probably been there at that situation where you end up cutting an MGA's paper and you don't really even know why. It's just like, it's just not happening anymore. We are pulling out of this and that's it. And if you're doing marine, we're not doing marine anymore. Sorry.
I hear this a lot in conversations with the MGAs where, more and more they're getting different levels of backing. And they just go, look, it's just too dangerous for us to stick where we are. We need to have fallback. We need to have other capacity. Because a new MD can come in and decide, look, we're going left, and that means that right won't be serviced anymore, and therefore our business is left high and dry. So it's the risk business. At the end of the day, you mitigate your risks. So I absolutely agree with you. I think they're going to widen their capacity. They're going to try and find people who are in there for the long term and give them commitment to the long term, deals for the long term. Why wouldn't you?
We're well away from the sort of 12-month renewal cycle. It's all multi-year as far as I can see. Or certainly there's a large ecosystem of markets available, all offering multi-year commitments.
And look, if you're an MGA that is got good underwriting and pricing discipline, claims oversight, is delivering consistent returns, and you've got an alignment of interests with your insurer capacity providers, then it's in your interests to sustain that and grow. And the good ones will stand out, and the ones that aren't so good, well, that will be a challenge for them.
I suppose from that MGA's perspective, once they've signed the 5-year deal and they know that's locked away, then they can actually invest in their business with a lot of confidence. If I can actually hire those people I've been meaning to hire, and we can bring them on, we can get that bigger office space or whatever it is, we can get the returns on this.
Well, exactly. I mean, we need the MGAs that we deal with to be looking forward and driving the business forward, not worrying about have I got my capacity for the next 6 months or the 6 months after that? Because that's an awful lot of management time and effort wasted that could be growing their business profitably.
And there any classes where you're particularly happy and sort of penciling in lots of growth where you're thinking, this is great, I want to do more of this?
We've got quite a wide appetite. As long as we've got the skills, and then we can see the partners that we work with have got the skills to write it and understand it, then we go in with our eyes open. But we do try and find those niches, those segments, right? It's not about sticking your rate on aggregate array and seeing what happens. That doesn't work for us. It's not our business. We'll leave that to the big guys with 1,000 pricing people and tens of years of data. But they can succeed in that market. That's not one that works for us.
Is there anything you wouldn't do, by the way?
Yeah, there's lots of things we wouldn't do. It's a long list, potentially. But for instance, one of the things we've taken a decision to is to not do cyber.
I was going to ask you about that because obviously it's been a huge growth class for everybody.
It is. And we've just taken the decision. One, we didn't have deep skills in it. I was going to acquire those. But we just took the decision that more and more we're seeing the risks in there are coming from state-sponsored and other things where really that's not what the policy was about.
And that's starting to get into very ambiguous terms in terms of your own reinsurance contract and what does it actually say? You know, again, will they be back to back with you on those things? And you can have, of course, you can have a massive argument and it takes forever to prove whether it was a state because most of the states are never going to admit that it was them anyway. So,
well, look, we had the whole fun around COVID with the pandemic wordings, and look how many big names got dragged through the mud because they were trying to get out of paying their claims because our wordings weren't clear. So anywhere there's ambiguity, we've just got to mitigate. We're not playing there. We want to play where the team have got skills and experience that we can help those MGAs grow their business.
So having said that, where do you think your core competencies are and where you're most happy?
We play a lot in mobility, gig economy type workers, in property and SME or non-standard, where we've got strong skills and underwriting skills. And that's been successful for us. And we continue to grow there. And we see an awful lot of opportunities come to us in those spaces.
Non-standard property, what's a typical example of?
Unoccupied.
Oh, right. Okay. So, yeah, things that are problematic for most people. Or is it sometimes, or that the occupancy itself is a little bit,
all of that.
It's not fireworks manufacturers and all that. Who knows?
I hope not.
I used to have a scheme of that 30 years ago, yeah. Spanish firework manufacturers liability, yeah, including all the employers.
Did that work out?
Went with a bang. They make their own fireworks and then do the displays as well. So you had crowds, something went wrong, you could burn people in the crowd. And if your deductible's too low, you certainly would have had a few claims just for someone's coat got singed. And of course, it turns out to be a very expensive coat.
It's one Gucci, I'm sure.
They all were. But you can do almost anything. But generally, it's things like, not nasty occupancies or, and all that sort of people who...
Often where the computer says no for the standard players. That drives stuff into our hands.
One other question about AI is, what do you think about AI as a risk in itself? Obviously, as a liability risk, professional indemnity or as an emissions risk, it's currently silent. I've just seen a few tickles here and there of a couple of schemes being launched here and there, explicitly name that peril and insure it, particularly from that professional indemnity angle. What's your view on it?
Well, one of the reasons we've taken some of the decisions we've done to make a human in the loop all the time is to address some of those points. We're not going to let the computer make the decision. We will let the computer inform an experienced person who will then make the decision. Actually, I've got a different angle on AI. I think some of the challenges in AI are going to be for how we make sure there's plenty of talent coming through in the insurance industry in years to come.
Yeah.
I think that's where a bigger challenge is going to be for the industry.
Yes, certainly, anecdotally, we're seeing slightly less hiring in the insurance industry for graduates this year, some of the numbers I've seen from the surveys. But at the same time, of course, almost on the same page is another story of people with, once they've got 6 years experience, all doubling their money and jumping from here to there, which doesn't seem to make a lot of sense. If we know we need more people, in 5 years' time when they become more valuable, we're doubling their money. Why don't we just have more people? Particularly when they're a bit cheaper and we can really train them the way we want them.
We've seen a 37%, I think was the number, reduction in graduates being hired in the UK. So it's not they're being fired, they're just not being hired, right? Yes. And that also corresponds, this will be the first year of graduates coming out of university who've had ChatGPT for all 3 years.
Yeah.
Okay. And the feedback from the lecturers is they work in a very different way, because it's not about memorizing stuff and reciting it, because actually they're leveraging the tool sets as well. So we've got that going on. I think the other bit for me, exactly to your point, is everyone wants a fully qualified accountant now, but they don't want to train them up to become fully qualified.
It does
right?
make a lot of sense.
For 3, 4 or 5 years, that's going to be great. People are going to make better returns because their costs are lower, etc. And then
It
when
really hit you,
the
won't it?
55 become 60 and retire, well, who's going to fill that? We're just going to have a gap. So that whole succession planning side of things is going to be very interesting, because there's a lot of pressure on a lot of CEOs, MDs, to hit the returns, to, make the margins. And this is a way you can do it. But your successors might be cursing you a little bit.
Yeah, because if you kick the can too far down the road, in year 6, it's suddenly going to start biting you. Your margins will start really plummeting. And to explain, well, we forgot to hire people 5 years ago.
The other thing it'll be supply and demand. You're going to have salaries going through the roof for the people who are qualified, because there's so few people coming through qualified, and the demand's still there. So you have that. I saw an article that said that actually, most companies at the moment are triangle shaped. So lots of people at the bottom, a few people at the top. And actually what AI will do is make it a diamond. So it'll actually go thick in the middle and not many people at the bottom, because you won't recruit them. And then over time, they said it'll then become an hourglass shape, because it'll hollow out middle management. The example I saw was a London cabbie driver, right? Black cab driver, has to sit the test, and he's got 20 years experience of driving people around London. Okay. Someone can get in the car, become an Uber driver, with sat nav, and compete with them. The tech has substituted them. Okay, or enabled them to compete on the same level. It's that sort of analogy, I think, flows through.
Well, like the old minicab firm, you had that skilled job in the radio. There's someone on the radio, looking at the map and saying, well, who can get from here to there, and doing that mapping. Of course, that's all done by the algorithm. So that middle manager job's not really there anymore. Well, the ones that aren't earning the value aren't going to survive.
So there'll be other jobs come out. I didn't know anything about YouTube content creators when I was leaving school. It's new industry, it's new jobs, it's so on. So things will develop. But I think certainly from an insurance perspective, we've got to make sure that talent's coming through.
Well, at least from Wakam's point of view, you're still small enough for it not to matter that much. You can just look after your house. You don't have to worry about the industry as a whole. But you're going to keep growing. I mean, should we expect to see you getting much bigger? Or what sort of growth rates are you going to be expecting?
So I'm very lucky. My board don't hold me to top lines. My board just want a consistent bottom line through the cycle and grow my bottom line. So I will grow my top line. It make a lot of sense. There's opportunities to do it. We've got capital available to do it as well. So I won't put a figure on there, but we'll grow steadily. And I think Wakam will be a name that's heard more and more over the next few years.
Well, Mark, I've really enjoyed talking to you. As I said, I think during the middle of the podcast, I spent so much of my time in the reinsurance, specialty, wholesale end of the world. I used to still wholesale, but slightly different, and very focused on that end user, that consumer. You've got to see at the end of it, and most of the things I do don't have the consumer ultimate at the end, unless that consumer is an enormous FTSE 100 or a Fortune 1000 company. So thanks so much for telling me all about it. It's been really interesting, and we'll get you back on the show in a couple of years' time. I think we'll have a check-in, see where you've got to.
That would be fantastic, and thank you very much for having me.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.